State Street Global Advisors Richard Lacaille in the studio with me now. He is the Global Chief Investment Officer, oversees some $1.9 trillion in assets under management. And Richard, so just give me your assessment of what we've seen with the corporates.
They seem a little bit better than expected. Certainly if you jog back to sort of July, August, so a lot of analysts trying to get ahead of what they thought were macroeconomic storms coming. And certainly from our perspective, we think, earnings are very high in proportion of GDP, so is it going to last forever? But somehow companies managed to pump out pretty good earnings. Now, I heard a comment before about risk-free growth. That always kind of raises the antenna. I don't think there's such a thing as risk-free, particularly at a moment where you've really gone as far as you can, possibly in terms of cost-cutting. And you need to see more sustainable economic growth.
So then, with that in mind, what are the potential headwinds to earnings growth going forward?
Well, I think we still need to see economic growth because the margins are at very high levels. So you have to ask the question, where's the next leg of earnings going to come from? And it's not that we think earnings are suddenly going to collapse or have a very strong headwind. But if you're going to post growth for 2012, you need to know where it's going to come from. And I guess that's a concern against the macroeconomic backdrop.
So just give me a very quick idea of where you see good value in the market right now, which sort of industries you're focusing on.
Well, I think there's a lot of indicators we look at. We've got quantitative models, we've got a fundamental team. But if you step back from it all, it looks like people are beginning to re-risk. And I think that's what a number of the models are saying, that now is the time where re-risking is going to take place. And that might sound at odds with that slightly gloomy macroeconomic picture. But at the same time, people are retreating.
So you're saying risk aversion has actually produced some good opportunities?
Risk aversion may have gone too far. And now, the spread between cheap stocks and dear stocks has emerged to a point where there's some opportunity.
Bank recapitalization to the tune of 106 billion euros, does that concern you at all?
Concern us in what sense? That it's a large number or a small one?
Well, either.
I think I'd have preferred it to be sooner than June. I expect it to be a bit bigger, and frankly I think for a portfolio investor it makes an awful lot of sense to recapitalize banks, because if the only thing you owned was one bank share, you'd have a very different view of recapitalization to if you own a whole portfolio of European equities, in which it's in your interest to make sure there's no credit crunch. So just supplying capital to a small part of your portfolio in banks actually saves the rest of your portfolio. So in that sense, I could envision this being bigger, and in fact sooner. But is 106 billion enough? I guess it comes with a couple of other things attached, which are quite interesting. One is a concerted attempt to restart the term funding market, and the second is to make the responsibility for some of these guarantees and liquidity schemes more European than national. And I think if you can break the link between national debt problems and the banks, that's 50% at least of the problem of trying to address the solvency or the liquidity of the banking system.
So if anything, you seem relatively optimistic, and actually you would like to see perhaps more recapitalization and at a quicker pace.
I think at a quicker pace, but I think what's happened is that still politics are at the heart of markets. So if you look at the spread today between Italian and Spanish bonds, they really have been, there's been quite a lot of differentiation between the two. I think just because people are uncertain about whether Italy can deliver from a political perspective. And so we're still in the same moment where politics are taking an outsized effect in financial markets. And for an investor, you've got to be a little bit cautious when that's the case.
And just going back to the banks, because you have equity holdings across Europe, don't you, Richard? So I'm just wondering, how concerned are you about the risks that this recapitalization, this regulation on the banks could potentially produce in terms of how the banks respond if they were to cut back on lending? Does that prevent your other investments from prospering potentially?
Well, it would do, which is why some of the other clauses, buried in that 15-page document that came out last night, were certainly things about term funding and an effort to make sure the banks didn't delever too much and that they revived the interbank market.
How difficult is that going to be?
Well, I don't think it's easy.
Yeah.
And I think you have to ask the question, what would it take to get us feeling comfortable with unsecured bank debt? And I think there's quite a big gap between now and the end of June, so we'll have to work out where we're going to go from that. But it doesn't seem like a very large number in some respects.
And you mentioned the politics. Goldman Sachs' note to clients today said that markets now appear to be resigned to the tardiness on the part of policymakers and are grudgingly prepared to accept that it's going to be a slow pace. We're not going to get a solution in a single step. That's what the note says. Do you see it that way?
I think it is a little bit that way, because again, in the document are buried a number of things about national governments and constitutions having a sort of balanced budget amendment in there. So how long is that going to take to get through? And in the meantime, where are we going to be in 2 or 3 years' time? I think that's what bond investors will be expecting, because the EFSF, unless it's continually recharged, it's going to end up running out at some point.
All right, good to get your thoughts. Thanks very much indeed, Richard Lacaille, State Street Global Advisors, Global Chief Investment Officer.